Good morning and/or good afternoon, everyone. My name is Jason Kennedy from Early Growth Financial Services. I will be your moderator and host today for this webinar, Spring Cleaning, Getting Your Financial House in Order. This is a partnership webinar we'll be putting on with Lighter Capital. Our two presenters today are BJ Lackland, the CEO of Lighter Capital, and Sirk, consulting CFO with Early Growth Financial Services. Our webinars usually last an hour long in total. We do have a Q&A period at the end of the webinar. You are welcome to use the questions panel in your GoToWebinar console to ask questions throughout the webinar. We will answer some questions, if possible, as we move along through the webinar. Otherwise, we will get to as many as possible at the end of the session. If we do not cover all the questions that are asked in the webinar, we'll of course follow up afterwards with some answers for you. So again, our presenters today, BJ Lackland, the CEO of Lighter Capital, and Sirk, consulting CFO with Early Growth Financial Services. We're going to talk really quickly about both companies and then jump right in. So Mr. Lackland, I'll start with you and Lighter Capital.
Yeah, thanks, Jason. Lighter Capital is an investor primarily in tech startups. We fund companies using a combination of what we call a revenue loan, sort of a hybrid between debt and equity, mixing the best aspects of equity and debt together. And we fund companies using technology. So we do a relatively high volume of fundings, relatively low dollar amounts. So our average investment is about $300,000, although we'll do anywhere from $50K to $2 million. And we do about 5 to 6 investments a month. To date, we've done just shy of 140 financings and just shy of 100 companies that we've funded.
Great, thank you, Mr. Lackland, and then we'll kick it over to Mr. Rowe about Early Growth Financial Services.
Great, thanks, Jason, and thank everyone for joining us today. We're thrilled to be doing this webinar with you guys. Early Growth Financial Services is a full-service accounting and financial consulting firm. We typically work in the SMB, the small and medium business space, which here in the Bay Area typically means tech startups. But in other parts of the country, we work in tech as well as other industries as well. We have offices in San Francisco, San Jose, Los Angeles, Seattle, Chicago, and New York. And basically, we provide 4 primary services. We do tax returns. We do company valuations. So, for example, if you are giving stock options to your employees, you have to be valuing your company and valuing your common stock on an annual basis at a minimum. And so we do those valuations. And then we provide consulting services by the hour for CFOs and accountants. And so basically for a lot of our companies, we are their accounting department, outsourced accounting department. And we work by the hour as opposed to on a retainer fee. We don't have any minimums. And we just kind of go as you go and grow as you grow to fit the needs of every one of our clients.
Great, thank you very much, Sirk. So again, the questions panel over on the side, for anybody that has questions throughout the webinar, please feel free to use that, and we'll go through those questions as quickly as we can. The overview today, we're going to start with accounting standards and then move quickly into the key financial statements that you need to know about. We're going to talk a little bit about cash burn, and then we're going to move over into growth metrics that you should know, what investors will be looking for from you, and then we'll do, as I mentioned, Q&A and wrap up towards the end. So it's that time of year. It's starting to be nice out. It's not quite hot yet. It's time for spring cleaning, just like it is in your house. You know, it's a great time to sit down and look at getting your financial house in order. So that's what we're going to talk about a little in depth today. And we're going to start with the accounting standards. And Sirk, if you can talk to us a little bit, start us off about cash versus accrual accounting.
Sure, I'd be happy to, Jason. And so, kind of as a precursor, I know that the audience here probably runs the entire gamut of very experienced, fully knowledgeable about financial statements and different accounting standards versus people who know very little about it. And so I'll kind of try to take the middle approach, more high level. We have other webinars and other presentations on our website that dive a little bit more in depth. into some of these items, but we'll just kind of do a high level. And basically, we'll start on the right side of this ledger here, which is cash accounting, which is very, very simple, which is you account for cash as it comes into the company and as it goes out of the company. And it's very, very easy to manage, because really all you're looking at is checking account and bank account and credit card records, as opposed to other things. And a lot of entrepreneurs appreciate using that because they are just focused on cash. But for most companies, you're going to want to do accrual accounting. And this is where, instead of looking just at cash, you're looking at actual timing of activities and when we should be recognizing certain activities. So, it's not all cash-based. So, for instance, if you have a SaaS model where you are collecting 12 months of premiums in advance, right, on January 1st, and that service is going to be good for 12 months, you wouldn't take all of that cash that comes in on January 1st as revenue in January. You would disperse it over the 12-month period. And the same with expenses. If an expense is incurred in a month, but you don't get an invoice for it and you don't pay it out until the following month, you want to recognize that expense was incurred in the month that it was incurred. And the reason why we do this is so that when investors, when other interested parties look at your financial statements, there are kind of a standard set of ground rules that you're abiding by, so that when someone looks at your financial statements and when you look at your financial statements, it can be compared apples to apples with other companies, and people get a really good sense as to the true financial condition of your company at that point in time.
Great. So let's jump into the balance sheet, sir.
So there's basically three, as most of you know, there's basically three main financial statements of a company. There's the balance sheet, there's the profit and loss or the income statement, and there's a cash flow statement. And together, those three financial statements really, again, tell a viewer what the financial condition of the company is at that point in time. The balance sheet is basically what it says. It balances out. Where the amount of your assets is equal to the amount of your liabilities plus your shareholders' equity. And this is at a point in time, so at any point in time, you should be able to take a snapshot and you should be able to say, okay, here are all my assets, which is everything that the company owns. Here are all the things that we owe, including things like credit card balances and accounts payable and debt. And other accrued expenses, things that have been accrued, again, going back to the previous slide, where we haven't paid it out yet. And then the remaining amount is the shareholders' equity, and that's basically, both for the founders and owners, as well as other equity investors in the company, and how much of that balance sheet is owned by the shareholders' equity. And here we kind of, for the purpose of this presentation, I kind of want to just make sure that everyone kind of understands the difference, especially on the balance sheet with regards to liabilities and shareholders' equity, because we're going to be talking about different types of investors. Lighter capital is a debt investor, which means that they are going to give you a loan. Other institutions like banks and other lenders will give you a loan, which will ultimately need to be paid back. As opposed to equity investment, which is, for example, seed and angel investors and venture capitalists who put money in not expecting to be paid back that money, but expecting to make money on the back end as a percentage owner of the company. And then there's other things like, common versus preferred stock. I think that's probably, a little bit beyond kind of what we want to talk about here. And again, there's other places, and we have other presentations that go into a lot more depth on subjects like this.
All right, so moving on to the profit and loss statement.
Yeah, the profit and loss, you may also hear the term income statement. It's basically the same thing. And this is basically what the activities of a company shows over a period of time. And the typical reporting periods are monthly, quarterly, annually. And the three main things here are, what these bullet points say, which is the amount of revenue that is being generated by the company, what the amount of the cost of that revenue is concerned. So, for example, if you have a product and you're manufacturing, and you sell something for $100 and costs you $50 to make that product, then that $50 would be a cost of goods sold, which then gets you, if you take the revenues and you subtract out the cost of goods sold, it gives you your gross margin. And that is basically the amount of margin being generated by the product or service that you're selling. And then below that is basically all of your expenses. So it's, it's a lot of your salaries, your corporate expenses, your rents, all that other stuff that you need to be spending in order to be running your business that is not specific to the actual product or service being sold. And it's really, this is obviously a critical item and something that, the founding team, all the team members of the company, as well as any investor is going to want to know is really, what does this model look like, right? How is revenue growing? How much is it costing us to produce that revenue? What does the expense structure look like? How is that going to change over time? If we're not making money, if we're losing money, then what's the path to getting to break even and beyond to where we're making money? And it's understanding the kind of the metrics of the business in order to be able to generate what's not only happened in the past but going forward in the future. And then going to the next slide, the cash flow statement is the final piece of it, and this kind of bridges what I would say that the P&L or the income statement versus the balance sheet. And a lot of people are a little bit confused about kind of what's in a cash flow statement, and basically what it does, it just starts with net income or what your profit and loss statements stated, and then it makes adjustments for all those other non-P&L items, so the balance sheet items, and it basically says where did the cash go or where did the cash come from, how much cash was generated or spent in a given month. And obviously, as a founder and an entrepreneur, you're going to be very, very interested in this one. But as investors and as accountants and CFOs, we're obviously very, very interested in the other two. And the cash flow statement is actually just a derivative of the other two statements.
All right, so let's talk a little bit about cash burn.
Yeah, and this one is near and dear to everyone's hearts. This is critical for the CFO as well as the founders and the entrepreneurs and the team members, obviously investors, and this is basically just keeping track of how much cash you have. Obviously, you always have to have that number at the tip of your tongue at any point in time, as well as how much you're spending. Right, and this is obviously meant as a tracking tool, particularly for companies who are kind of in their growth in the investment stage, where they are growing their company. They're probably burning cash, as they're doing so, as they're trying to get to profitability. Once you're at the point of profitability and you have more cash coming in than going out, then this is not as critical, although you still want to know it. But for a company that is spending money, burning money, trying to grow their company, this is a critical thing that you have to know, and this is something we have to be keeping track of on a monthly basis. And at any point in time, you should be able to say, I've got this much cash. This is how much I'm spending on a monthly basis. This is how much time I have to live. We call it runway. We call it time to live. Whatever you want to call it, but knowing how much cash you have at any point in time and how long it's going to carry you is obviously very, very critical, and this is what we're trying to maximize as we talk about different types of investments and where to go for those.
And this is BJ. As an investor, obviously, all these financial statements that Sirk's outlined are really important. But knowing the burn rate and knowing your ramp, so knowing the runway you have until you will run out of cash is incredibly important. I think one of the things that we frequently see that's sort of good to clear up is entrepreneurs are a little bit confused about what does the burn rate really mean. Is it the net burn rate? In other words, sort of how much does your bank account go down month over month? Or is it sort of the gross burn rate, meaning what's the total amount of money you're spending in a given month? Most of the time, I think investors mean net burn rate, but you can always just say net if you want and say, hey, our total spend in a month is $200,000 and our net burn rate is $100,000 to clarify it. But just like Sirk said, knowing it off the top of your tongue and knowing how long you've got until the till runs dry is paramount.
And the rest of this presentation is going to be about how do we maximize this, right? And different places we can go. But again, just being able to communicate very quickly, very eloquently to anyone who asks, any investor that you're going to be talking with, is absolutely critical. You need to know that other stuff too, but this is the first thing that they're going to ask you.
So I've got a question that came in that actually pertains to burn rate here. Is there a dollar amount or a ratio for each month that will scare off investors, or does it vary from company to company or situation to situation?
Well, it definitely varies from situation to situation. And it's also going to vary depending on how much funding you've got. But all of that is kind of intertwined, right? If you're trying to create a really small app, for example, and you have 2 or 3 engineers who are working on it, and you're only burning $30,000 or $40,000 of cash per month, and we see companies that are able to do that. Then obviously that's something very, very different than someone who's trying to build a big product and they have to, go through, a lot of material and manufacturing processes. And so it's going to depend on the service and or product that you are that you're trying to bring to market. It's also going to depend on the phase of the company, right? So at an early stage when you're just doing some development, just trying to see if there's a market, you probably have a lower burn. As you get a little bit later on and you've developed the product and you're really going after market share, for example, and trying to acquire customers, you'll probably burn more. And so it does depend on the specific company and situation.
Yeah, I'd say the same thing, which is always hard to say it depends, but it does depend, and then I totally agree with Sirk. The one other thing I think it depends a lot on is the investor that you're talking to. For example, here at Lighter Capital, we can only provide companies up to a couple $1 million. So knowing that we can provide them enough capital to survive means that they can't be burning monstrous amounts of capital. On the other hand, if you went to sort of a mega VC like Andreessen Horowitz or something like that really looks to fund incredibly disruptive technologies and can cut $20 million checks without taking a breath, that's a whole different sort of prospect to them as it is to us. And so the ratio, like the question was, the ratio of sort of revenue to burn rate can really depend. I mean, you can imagine at some place like a Zenefits, where they're really burning tens of millions of dollars a month. The investors felt like that was worthwhile given the opportunity that they had and the increase in revenue that they were seeing. Or someplace like Instagram, where they had a decently high burn rate because they had no revenue at all, but they were showing incredible traction, and so the investors there were willing to support that company in that burn rate because they knew they had something that was being highly valued by users, even if it hadn't yet been monetized. So it depends, like Sirk said, on both the company and the offering, and also things. Also depends a little bit on the investor and the investor's appetite for supporting non-revenue related metrics of growth.
Yeah, we'll talk a little bit later about different types of investors and what they're going to be looking for, and maybe even a little bit about kind of who you should be targeting at different stages.
Yeah.
Okay, great. I think we're going to talk a little bit about key growth metrics here quickly. BJ, you want to kind of jump in and talk a little bit, or Sirk? Who wants to? Yeah. We'll start with monthly recurring revenue.
Sure. I can jump in and talk about these, and these are select metrics that probably everyone should know, especially when you're going to go out and start talking to investors, but also, frankly, just to manage your business and make sure that you're headed in the right direction. I can go through these things really quickly, and there's certainly lots of other metrics out there, and the most important metrics for your business are going to vary a little bit, but these seem relatively universal as things you're going to want to know. So for some monthly recurring revenue, is just literally the amount of revenue you have that's recurring, sometimes called your ARR, if it's annual recurring revenue, but divided down into a monthly basis. So if you've got 10 year-long contracts and each one is $120,000, well, your monthly recurring revenue is probably $100,000. So that's really the recurring portion. You may have non-recurring revenue, which would be things like one-time services, setup, integration fees, things like that. The run rate is really the sort of current, and current usually means this month, maybe last month type of thing. The current annualized amount of revenue you've got. So taking sort of the average monthly revenue you've had for the last couple months or so, and then multiplying it by 12 and getting an annual amount. So the example here is $100,000 in monthly revenue is a $1.2 million run rate. And a lot of times, especially with really fast growth companies, the run rate is something that investors in particular are more important, more tuned into than, say, the last 12 months of revenue or 2015 revenue or something like that, because you'll have grown so much you now look like quite a different company, your current numbers. Next one, the customer unit economics. This is really a cluster of different things put together, but if you understand your unit economics to your customer, that means you really understand what does it cost for you to acquire a customer, what does it cost you to service a customer, what does it cost overall, what's the lifetime value of that customer. So you can show an investor, hey, if I have my average customer is bringing me $100 in lifetime value and it costs me $10 to acquire them and it costs me $5 a year to service them for X number of years, then at the end of the day I'm getting a certain amount of profitability per customer. And obviously, especially if you're raising money to go and acquire more customers, the investors and such want to know that basically each customer you bring in is going to be profitable for you. And frankly, you as an operator are going to want to know that as well. Gross margin, hopefully folks understand that it's really revenue minus the cost of goods sold over revenue. So it's really like, what are you making towards your operating expenses on each dollar of revenue that's coming in the door. A lot of the companies that we fund at Ladder Capital, on average, the companies we fund have an 83% gross margin, to give you an example. We fund a lot of SaaS companies and software companies that have very, very high gross margins. If you're in a more like an industrial field, then you're probably going to have margins that are anywhere from 10% to 60%. It'll be very, very different than software. A churn rate, really this is how many customers you lose over a period of time. And it's particularly something that we're attuned to when we're thinking about recurring revenue. So if you started 2014 with 100 customers, at the end of 2015, how many of those customers were still using you? If it was 80, well, then you had a 20% churn rate. There are lots of different ways to look at churn. The example I just described here is sort of customer count churn. You can also look at revenue-based churn. So, what revenue were you getting from those customers at the beginning of 2014 compared to what revenue you were getting from the 80 remaining customers at the end of 2015. And you might end up with net negative churn if your customers end up buying more from you over time. But knowing all those different churn rates is going to be important, both for operations and, again, for talking to investors. And then customer lifetime value is exactly what it says. What is the average customer worth to you over the lifetime of your relationship with them? And Sirk, maybe you have a couple other examples or ideas? Or?
Yeah, and I'll kind of try to tie it together also with some of the earlier slides. And obviously this is a set of metrics that certainly a software as a service or a SaaS company these would be critical items. And you may have a company where the metrics are different. You probably will if it's not a SaaS company. But understanding what those metrics are and understanding the key drivers of success of your company and how you model that out and how you are planning to achieve your goals is obviously going to be critical in your ability to not only run the business but ultimately get investor interest. And to basically tie this together, so it's clear that you need to know this stuff, and you need to know how these numbers change over time, because all of this is really going to drive, I guess the formation of your forecasts, right, going forward. And I would certainly suggest that you put together a financial model that takes in and that is run by the assumptions that you are using, for the metrics, for the key metrics of your company, and use those to build a set of financial projections that look forward, that then gives you an idea of the kind of opportunities there are, the kind of revenue that you're expecting to see, how you're going to get that growth, and ultimately how much cash and when you need that cash as investment in order for you to achieve your goals. And it's going to be just impossible to do any of that stuff unless you model it out using these types of key metrics as the basic assumptions of your model.
Yeah, I think that's a really good point on the modeling. Because one of the things that happens when you sit down and are forced to, you model out your business, you're forced to go and figure out what those key assumptions are for your business, just like Sirk is saying. And I can't tell you how many times as an investor, both at Lighter Capital as well as earlier in my career as a VC for 5-6 years, looking at someone's model and saying like, okay, so what are the key drivers? You walk me through this model, talking to the entrepreneur, so you walk me through this model and tell me what are the key drivers that are going to drive things up and things down. And if they don't have a really good grasp on what the key assumptions are in their model and what moves revenue up and moves it down, or shortening sales cycles or lengthening or whatever, it really tells you something about the entrepreneur and whether they really understand what drives their business or not. So I emphatically agree with Sirk that like going through and creating a model like that, and whether you can do it yourself or you need someone like EGFS to do it, it's really critical, both for operating as well as for talking to investors. I mean, on the operating side, there's an old maxim that if you can't measure it, you can't manage it. And obviously that's a little bit backward looking in terms of the metrics that they've been, but also then that leads into how you plan out the future.
Right, great. So BJ, let's put it back in your court here, talk a little bit about what investors care about, what they're looking for.
Yeah, we put together a slide with a couple of different ones in mind. Obviously, we're a revenue loan provider, so Lighter Capital itself is on the right here, as well as an equity, which is a pretty deep bucket. That could be angel investors investing $20,000 in a deal. It could be VCs putting in $100 million. So there's a lot of variation that's possible in here. So don't take these reds and greens and stuff as quite gospel, but I want to try and outline a little bit. So the greens mean it's very important. This area is very important to that type of investor. The red means it's less important. And then the yellow sort of sometimes is important, sometimes not. So you walk these a little bit, and talk to different investors. You'll hear lots of different stories about what are the main things that they think about. But these items here on the left column, team, market, et cetera, a lot of investors will look at these different kinds of things. You could probably add or subtract a couple. But overall, everyone's going to care about the team and the people. If you're an equity investor, it's absolutely paramount that you're going to be knowing the people and believing in those people. To give you an idea, as a Series A investor, like I was when I was a VC, you're looking at these people and expecting you're going to live with them for 7 years, because that's about the length of time that a Series A investment takes to get to a liquidity event. So you can imagine if you're sitting on the board and talking to people every week, you really want to have good people for partly your personal enjoyment each week, but also because that's really what's going to drive the business and attract other good people. On the other hand, Lighter Capital, as a revenue loan provider, we really care a lot too. We're less hands-on than the VC. We sort of call ourselves VC light, but we really care that these are good and honest people who are doing their best to build their businesses. That's really what we're backing. I won't spend so much time on all these, but I'll skip in a little bit. Market size, to an equity investor, it's huge. If you're going to return 10x to their money like an early investor wants to see, you better have a large market size. And it's a little bit mixed in with disruptive technology, because disruptive technologies can often make their own new market. So these are very, very similar. To a revenue loan provider, we're actually looking a little more sometimes at existing markets. We don't try to guess where the market is going deep into the future, nearly as much as a longer-term equity investor is. So it's less important to a Lighter Capital and less in red here, revenue loan provider. Traction, depends on your metrics, like we were just talking about. Which are the key metrics? Could be revenue, could be users, could be eyeballs on your page, whatever it is. Metrics going up and to the right, every investor wants to see. They want to understand, that there's increased usage, increased engagement, increased revenue coming off the business. And revenue is always an interesting one, kind of like we were talking about with burn rate. Some equity investors don't really care as much about revenue because they want to see other forms of traction, and they tend to be an earlier stage investor, perhaps. Whereas, say, Lighter Capital providing a revenue loan, we're providing a loan against revenue, so it's absolutely critical the company have revenue. We can't fund a company unless they've got at least $15,000 a month in revenue. Competition, I think, is probably relatively straightforward. A little more important to an equity investor that might want to be backing a company that dominates the market, as opposed to as a revenue loan provider. We don't care quite as much. We fund actually a lot of companies that are in relatively competitive markets. So long as they've got a good niche they can defend, that's great with us. And then financing risk is one that can really divide a lot of investors. Financing risk means, and going back to that burn rate conversation again, it really means what are the chances you're going to run out of money, or what are the chances you're not going to be able to secure future financing, and therefore at risk of the company going under. Avoiding financing risk or minimizing financing risk is incredibly important to Lighter Capital. We want to understand that the company won't need any more capital than we can provide them, that they're not dependent upon equity investors coming in 3 months after we've funded them or something like that. That's really a bridge loan. It's not really what Lighter Capital is meant to do. We're a long-term growth capital provider. Whereas equity investors, especially a deep-pocketed VC that can fund the company through many, many stages of growth, financing risk, because they hold significant deep pools of capital, financing risk is perfectly fine with them because they can always increase the amount of funding they're putting in the company themselves. So that's something that to them is far less important to avoid. And certainly, I'm sure you got any
one thing that I wanted to just add to this was really, and I almost wanted to ask Jason to ultra highlight the team people, in a big font here because of just how important it is for everyone, right? And if you think about it from an investor standpoint, a lot of times, and Lighter Capital is a revenue base, so they're going to be really looking at traction and seeing how much traction and revenue that you've got going. As a means, and so there's a little bit less judgment involved there. But if you're talking to an equity investor or someone who's going to be in there with you for the long haul, I mean, you have to assume that they are talking with other companies that are doing something similar. I get this question from entrepreneurs, or I get this comment from entrepreneurs when I ask about competition, and they say, "Well, we really don't have any competition," and I always push that back on them and say, "Is that really the message you want to send to investors? Because basically, what you're saying is that this market isn't big enough for there to be other competitors." Because in this market-driven society, if there's a big opportunity, there's going to be other competitors, either now or coming up right on your heels. And so, understanding that and understanding that the dynamic that the investors are looking at when they're making an investment, they're making a bet, right? They're making a bet that you're going to be successful, and so assuming that there's going to be other competition, the quality of the team is going to play probably the major factor here in whether you get the investment or someone else. And to that point, again, kind of recircling back to that whole understanding your business, understanding your metrics, understanding your key drivers, understanding how those key drivers really, really drive. I can tell you that a lot of times 3 or 4 key metrics drive 80% of the financial model. And so understanding that and being able to communicate that will give any investor that you're talking with a sense of confidence in your ability to not only know your business and your company and the industry, but also in your ability to manage it.
Yeah, I think you're totally right. Like, team is really paramount among all of these. Even to the point where if you have the right team versus the wrong team, a lot of the rest of these almost don't matter nearly as much. Plenty of examples of companies that launched with a good team, they decided not too far into it that the idea they were pursuing wasn't that great. They shifted and ended up making a successful business and ended up making the investors a lot of money with basically a different bet in a certain kind of way, but with the same team. So whereas you might have an outstanding idea, but with the wrong people, you're probably never going to succeed.
Yep.
So it happens all the time.
Yeah, we talk about pivots a lot, right? Because every company is early stage companies do it all the time. They'll pivot. You know, they'll look at a market differently. They'll look at their customers differently. They'll look at their method of delivery differently. And you know, 6 months in, 12 months in, 24 months in, it may look like a very different company. And again, kind of the ability to be able to do that, to be able to see it, have visibility into it, and make the adjustments. Is obviously going to be critical to your success, and if you can convey that to investors that you're talking to, if they get that sense of confidence, you're going to be able to do that. It's going to go a long way.
Yeah, and then the sort of add-on effect of, you know, good people attract good people. So if you're an early stage investor looking at, you know, backing a founding team, the quality of those people is probably going to be magnified out by the people that they attract. So yeah, it really is paramount.
All right. So moving on to preparing for the big meeting. BJ, what should folks get ready for? What should they know?
Yeah, there are a couple different things here, obviously, and we split them side by side. Sort of knowing the investor that you're going to meet. And then knowing yourself. We've covered a little bit of the knowing yourself stuff, like knowing the numbers and such, and how important that is to give the investor confidence. So maybe I'll start with that, sort of segued into it. But really can't emphasize enough, just like Sirk and I both said, knowing your numbers, knowing them cold, being able to just roll them off your tongue like it's something you know every day is just incredibly important. I spent a lot of my life as an investor, somewhat, but also, frankly, as an operator raising money. And I'll even do things like sit in a parking lot outside of where I'm going to have the meeting and go through the financial model or go through the recent financials or actuals or things like that right before the meeting, so it is literally top of mind. You know, I try to stay abreast of it day in, day out in running the businesses and such, but there's nothing like it being right top of mind, or when they ask you something, you know, having it immediately come out of your mouth and not have to like fumble around and think about it and guess and such. That just shows a terrible sort of gives a lack of confidence to the investor. The elevator pitch and the value prop, I think those are relatively obvious, but a lot of times when you're inside a business, it's just so hard to boil down what the business does to a couple quick sentences, or to find an easy analog about what your business is. It can often be so hard when you're inside the business to do this cleanly. A lot of times it will take you twice as long to get half the words, but it'll be well worth that time to make it really crisp and clean. Then knowing some of the, people talked some of those things, the addressable market and the competitive landscape. Exactly as Sirk said, if you say, you know, we don't have any competition, you know, a lot of investors kind of roll their eyes because you always think it sounds good to say that to as an entrepreneur, like, hey, we don't have anything, we're just going to dominate this market. But investors are realistic people, at least quality, experienced investors are, and what they're going to read from that is, number one, you probably don't know the competitive landscape, number one. Number two, you're being a little bit unrealistic about it. Number three, you probably aren't taking into account the things that aren't direct competitors today, but that could affect your business long term. You know, this sort of old Michael Porter of Harvard Business School uses old SWOT analysis: strengths, weaknesses, opportunities, and threats. And if you don't know, you know, those threats and such, you know, VCs and things like that, especially, are really not going to find you that credible a lot of times. It's better to tell them about a competitor and know why you're different than they are and be able to explain that quickly. That's really more important. And then also, like, sort of knowing what you're looking for. That may change a little bit here and there with different investors as you talk to them, but knowing how much funding you're looking for, how far it'll get you, what you're going to do with it, what the focus is. You know, it's sort of like, why are we meeting today? Kind of is ultimately that's what it is when you're meeting with an investor. There's lots more that you know about yourself, but let me skip over a little bit onto the left side of knowing the investor. And I must say, a ton of entrepreneurs that we speak with, especially ones that we're helping prepare. Maybe we funded them and we're helping prepare them up to go into other investor meetings. We'll do a little bit of coaching session and go through it and ask them some of these questions. And it's amazing how often they don't really know the answers to some of these things about the investors they're going to meet with, which means they really haven't even done sort of an extensive view of the investor's website sometimes. But let me go through some of these, and they're plenty more. So stage and funding preference, right? If you're looking for $500,000 from a seed investor, don't really go after an investor that only does $10 million Series B rounds. Might be good to meet if you have a good mutual friend for sort of planting seeds for the future, but don't go and pitch them because they're never going to invest in you. That's probably not going to happen. So knowing what they really invest in, it kind of goes with the last bullet point here, target requirements and investment guidelines. A lot of investors will put right on their website, you know, this is what we fund. We fund companies that are at the following stage, or we tend to invest this amount of dollars at this stage. So make sure you're a fit, make sure you understand what that is, and make sure it fits with your ask, right? If you're asking for $20 million and you're talking to a $500,000 investor, you're probably barking up the wrong tree. Sector focus, the next thing here is, you know, some VCs are a bit generalist, or they'll invest broadly in, like, you know, sort of tech companies, software companies and such. But if somebody never does a, you know, healthcare play, or somebody say is only focused on healthcare investments, well, you better know that, obviously, going in. Understand what they're really interested in. And this combines a little bit with the next bullet point, sort of the existing portfolio, right? Look at what that investor is invested in. And by that investor, I really mean both the firm, what are they interested in broadly, as well as the individual you're meeting with, because you may be going to meet with a firm, XYZ VC or something like that, and they may have invested in things sort of adjacent to your area, but the individual you've been introduced to really doesn't. That person handles a completely different area of things. So you're a fintech company, and you're going in to meet with the person who leads their digital media investments. Well, you're meeting with the wrong person, and you should know that. That may be perfectly fine. You shouldn't, you know, walk away from that introduction necessarily, but you should understand that probably your goal is to get over to the partner that does invest in your area. So those are really some of the just absolute rudimentary basics. If you can find as much about an investor as possible overall to know really what their interests were, what they aren't, that's going to give you a huge leg up. Definitely go look at their LinkedIn profiles and right up here, but there are several VCs I've spoken with who say they'll go look at their LinkedIn profiles before meeting with someone just to see if that person has looked them up. And if you haven't, it's sort of a red flag, which is an interesting one. As a sort of a tell sign that you haven't really gone and done your homework. So I guess that's really the bottom line here is do your homework on the investor and know who you're speaking to, what their interests are. And Sirk, I'm sure you've got tons more ideas than this.
Yeah, you know, and I'm glad we saved a fair amount of time. This is a slide, and you could add more to this, but this is a slide that you could easily spend an hour or two on just discussing because there's so much here.
Yeah.
And I agree with everything that you said, BJ. And I'll add just a couple of things. You know, I get this question a lot about, okay, that all sounds good. It's great. You know, of course, I want to know, you know, the investor, and I want to know who they're investing in and what their sizes are, and you know, but boy, there's just so many investors. How do I get that information? And there's places, obviously, online. But really, you know, you need to be networking, right? If you're an entrepreneur who's looking for an investment from anybody, you know, first and foremost, you are a salesman, right? You're supposed to be everything for the company, but ultimately you're supposed to be selling. And part of selling your company, part of doing everything you're supposed to be doing is to always be selling your company. And talking with other people who might be able to help you. So, you know, throughout the entire process, you should be getting an idea of the stage that you're going after and a list of possible investors, and do deep dives into their investment philosophies, and making sure that there's a good fit before you get introduced. When it's time for an introduction, get a warm introduction, right? Don't reach out to them directly with an email saying, hey, listen, I think that we have a product or a technology or a company that you might be interested in, I'd love to set up a call with you. Find a way to get introduced by someone that the investor already knows, has worked with, has respect for. And you do that by talking with other entrepreneurs. You might look on their website to see, and LinkedIn to see what other companies they've invested in. You might reach out to some of those companies and say, hey, look, we have a complementary technology here. I'd love to chat with you about it and find out your experience with working with so-and-so investor. And finding ways of getting a nice, warm introduction to the investor from someone he or she knows.
Yeah.
We talk about one thing that maybe is not as critical for BJ, but it is from my perspective as a CFO, and we talk about things like milestone-based financing, right? And so when this kind of goes to the ask, right? How much funding and what you'll do with it? We just believe so strongly that you should be looking for an amount of money that will allow you to meet certain goals. Time frame is important, so you don't want to be raising money and pitching ideas, because fundraising is basically almost a full-time activity. So you don't want to be raising enough money to last you 3 to 6 months where you're just going to have to go out and start fundraising again. So we say that you should be kind of targeting like the 18-month range for a full like equity round of financing. But understanding what you're going to be doing with it, and understanding the concept of valuation of your company is really, really critical. And the way that, and what I say about that is the valuation of your company is not linear, right? It's not a curve, right? It takes step functions, hopefully step functions in the positive. And those step functions, those big increases in valuation, happen when you hit milestones. And so know what you're trying to do with the money that you're asking for. Make sure that it's going to be sufficient to get you to meet those milestones, so that on the next round of financing, let's say you have to go for a Series B after a Series A, or a Series C after a B, so that knowing that you're going to make those milestones will make the valuation of your company take that big significant jump, so that when you get that next round of financing, it's going to be on better terms for you, and you're going to be able to raise more money by giving up less of the company. And to that point, I'll add the likes of lighter capital and other debt sources as a really, really great way of enabling you to do that without giving away a ton of your company at an early stage, right? So let's say, for example, you're going to need $3 million, right, to get kind of to take the next step up in your company, and yet you kind of also know that giving away raising $3 million today, first of all, if it's even doable, I'm going to be giving a big chunk of my company away, right? And so instead of doing that, try to figure out if it's something where you can do a $2 million raise and give up less of your company, and supplement that with debt, from the likes of lighter capital. That is a great way to structure investments, so that it works best to your advantage, and also gives investors like lighter capital more peace of mind, because if you just raise some money from a VC and you're increasing your revenue, obviously it's going to make it much easier for them to say yes to you at that point as well.
Yeah. No, I think you're right. We could talk about this forever. A bunch of different ideas came up when you're saying that, Sirk. One that you touched upon a little bit, that I think is always a question I hear from entrepreneurs is, should I wait to go start talking to investors when I'm actively pitching and looking for money, or should I just always be talking to them? And the pros and cons, I'm sure you have, there are pros and cons to that. The one thing I always say to people, though, is don't go talk to investors if you're not really prepared for the conversation. So whether you're actively raising or not, know all this stuff on the right here, know all your numbers, know all your metrics, because the last thing you want to do is go and make a bad impression. That's just going to, mark you off as a negative for the future. You're not actually planting seeds. You're actually sort of, burning bridges in a way. So know your stuff as though you were raising money, even if you're sort of outward statement to the VC is that you're not necessarily raising money at the time. You're just looking for introductions for the future when you are planning to raise in a year or something like that. Investors do like meeting people early, especially if they're impressive and they have something interesting, and they then, just as Sirk, as you were saying, then they understand what milestones are coming up for the business, and then they like to see them go hit those milestones over time. As an equity investor, back when I was a VC, I loved to see that stuff. You meet with people, you think, wow, they're really impressive. They're a little early, they're this, they're that, they're not in the market for funds today. And if they can go get these next couple of things done that if they get done, that's pretty impressive. And then they'd come back to you, 3-6 months later, whatever, and they've gotten it done. There's no more sort of like proof of the pudding than actual proof in the pudding for that kind of stuff. So that's one that I think is a question I hear a lot. Another thing that you mentioned was getting a warm introduction, and I sort of cut both ways on this one, interestingly enough. I think if you're going to raise equity money, getting a warm introduction is basically mandatory. Like going to a VC's website and writing to their info at, blah, blah, blah capital, just forget it. Like, it's not worth it. Go find a connection, go find an introduction. And so I, absolutely, of course, in agreement with Sirk with that. And there are a variety of different ways to get those introductions. It could be through your lawyer, it can be through other portfolio companies that investor has funded. It could be through whatever kind of connection you can find on LinkedIn. It could be one of your existing angel or VC investors, and all down the line. And people debate, which is really the strongest source of reference and such all day long. But overall, a warm introduction from someone that knows you well is worth gold. Now that being said, ironically, lighter capital is sort of on the strange flip side of that coin, which is the vast majority of the companies we fund actually just reply through our website, but we're built in a different way than an equity investor is. That's one of the things that we're built to do. So we are sort of the one big caveat to that, I think, in that the vast majority of the companies that we fund really do just come to our website and apply, and then we start talking to them, and that works great for us. But that's very uncommon.
Yeah, that's a good point, and sorry about that, BJ. I was making more of a blanket statement that you kind of want to take an approach, with regards to introductions, and I'll put in kind of a one plug for early growth and the likes of early growth. BJ mentioned find ways of find other people that can help you get introduced, and this is where I say use your ecosystem, right? And when I say ecosystem, I mean if you're a startup, if you're a tech startup, everyone that you're working with should be part of an ecosystem, right? The lawyer that you're working with should understand your needs as a technology startup company, and know who the players are, can make introductions to VCs. Same thing with bankers. Certainly, early growth, we kind of cut our teeth on working in the tech startup space, and so we know all the VCs out here, certainly on Sand Hill, as well as many of the investors in Chicago area and New York, and down in LA. And so using anyone and everyone that that you're working with is a great way of doing it. And if you're working with service providers who really are not able to do that, if all they can do is, I can do accounting for you, well, how much value add is there? There's a lot of people who can do accounting. There's a lot of lawyers out there. They should be able to add a little bit more value than just that actual service. Especially as a startup, you need to surround yourself with people who understand what your needs are and are going to be able to help you get to where you need to go.
Yeah, and to sort of double down on that one, I think, especially the sort of outside financial stuff like EGFS does, lawyers and things like that, they're almost doing two sides of it. One is, you're exactly right, you're going to get the reference into investors and things like that, and then frankly, when you get into the soup, like let's say you get an investor interested, and they're floating term sheets, they're asking questions and such. If you've got a sort of schlocky general counsel, or you've got just your average sort of accountant bookkeeper and you've gone cheap on that, you're not going to handle those questions well. Number one, probably. You're not going to have the model that you need to answer those questions, whatever it may be. There's a bunch of weakness points that can come up there, as well as the fact that you're going to get perspective from a lawyer that's heavily involved in the space, or EGFS, about, hey, I got this term sheet, does it seem like it's market? Because people like EDFS and lawyers that do a lot of deals in the space, they know what's going on in the market. They're working with tons of companies. They see a lot of this stuff all the time. It's like they know what's reasonable. They know what's not reasonable. They know what sort of trends are in terms of a term sheet, all kinds of things like that. So I think it's partly not only just like lining up your ecosystem of different companies you're working with to provide services and do what else and partner with. They're going to help you with your referrals. It's also helping you manage that entire process once you actually get an investor interested. Because frankly, those people are kind of part of your team, right? We're back to the what do investors look for. You know, if you have a good meeting with the VC, okay, that's great. You may have impressed them and such, but you're going to have a series of meetings, and they're going to look at a whole bunch of different information. And so if you're using a law firm that they know, and they know you've chosen reasonably wisely, and you're being well taken care of on the legal side, and you've got a reputable group doing the numbers like an EGFS and such, it gives an investor a lot of comfort. Number one, that what they're seeing in terms of the legal and the financial information is accurate and true. It also gives them confidence that you made wise decisions about the people to work with. So they're part of your team, really.
Great. So let's kick it over to a few questions here in our Q&A, and we'll wrap it up here. I think this has all been fantastic, gentlemen. Thank you very much. For those attending, again, as a quick reminder, you can use the questions pane over in your GoToWebinar console. Here on the Q&A, of course, we've got contact information for both Lighter Capital and Early Growth Financial Services if you feel you need to reach out to either with questions after the webinar. So we'll hit a couple of questions here, and then we'll wrap it up. One that came in earlier that kicks back to cash versus accrual accounting. Sirk, I'll let you start with this one, and BJ, you can answer as well. When taking on a new client, do you ask if they are using cash or accrual accounting? Or do you assume they are on cash accounting and you make the decision to make them use accrual? Does that make sense?
Yeah, it does make sense. For most of our clients, if they are using an accounting system, it's usually QuickBooks. QuickBooks easily allows you to go from cash to accrual accounting relatively easily. But yeah, we will push accrual accounting in almost all cases. There may be a corner case where they're really never going to go for investment, and they're only carried about cash, and their tax returns are based upon cash and all that, and there we might keep them on cash. But in most cases, regardless of whether they're on cash or not, we will push to go to accrual accounting basis.
Yeah, I mean, as an investment companies, we fund a lot of companies that do cash accounting, as well as a lot of companies that do accrual, of course. But I think we're a bit rare in that we're pretty forgiving with cash. If you want to get like a VC round or something like that, you need to be on accrual. So when we fund a lot of companies, there are a decent amount that do cash accounting. But most of those, once they grow up a little bit more, switch over to accrual. Nobody switches from accrual to cash. That's a one-way street, pretty much.
All right, I've got another question here, BJ, for you. And I know you had mentioned earlier in the webinar that you guys looking for usually a minimum of $15,000 in monthly revenue to be able to look at a company. But I've got a question here from someone that, if you could, just at a high level, kind of explain what a revenue loan is for those who have just been looking at traditional kind of equity financing as a solution.
Yep. Yeah, revenue loan is essentially a royalty agreement. So we provide a company a sum of money, say $100,000. It's anywhere from $50K to $2 million. For an example, say it's $100,000. Then the company pays us a percentage of their revenue each month, say 3%, until they've paid us a set multiple of that $100,000 back, usually somewhere between 1.5 to 2 times that amount. We expect that's going to be over a many year period of time. It's meant to be long-term growth capital that is less expensive than equity if you're successful at building your business, and somewhat of a substitute for equity. So it's going to be more expensive than a bank debt. A bank is going to provide you with cheapest capital, but it's also going to be relatively restrictive, but cheaper than equity if you're successful. So the goal of it overall, as I sort of alluded to at the very beginning, is to bring together the best aspects of debt and equity. The best aspects of debt is that it's non-dilutive to the entrepreneur and sort of leaves them in control. The best aspect of equity is that it aligns the interest of the entrepreneur and the investor toward growth. And so for us, we're a non-dilutive source of capital, so we don't take any shares in the business, we don't take board seats or anything like that, so we're kind of like debt in that regard. But we're a bit like equity in that our rate of return, our ROI, depends entirely on the performance of the business. So if the business grows much faster than we expect, we may get our total sum of money back faster than we expect, in which case our ROI goes up. If it grows more slowly than we expect, then our ROI goes down, and it'll take a lot longer for us to get paid back. And that's the risk we're taking. So we see ourselves as a little bit of a hybrid between a debt investor and an equity investor, because we really are focused on the future growth of the business, and that really drives our return, much like an equity investor. But at the end of the day, we're not dilutive, and so don't own shares.
Okay, great. Thank you again, gentlemen. I think we're going to wrap it up right there. For those of you watching, we do have a couple of appendix slides here that I'll cycle through pretty quickly as we wrap up. And as a reminder for all attendees, we will have this presentation recorded, and you will get a copy of this recording within 24 hours. So please keep a lookout for that in your email. Here we've got a little bit of guidance regarding metrics and software. So we've got some information there. And then we've also got some additional reading around the topics we've discussed today, developed by both Lighter Capital and Early Growth Financial Services. So some other links that you can kind of check out there in your spare time. So DJ, Sirk, I want to thank you again for joining us today and sharing some great insight on this topic. And for everyone else that's attending, thank you again for coming, and have a good rest of your week.
All right, thanks, everyone.
Thanks, everyone.